Welcome to the deep dive. We've got a pile of sources you sent over covering, well, what feels like a pivotal week, October 19th to the 27th, 2025. It seems like this was the moment legacy finance and decentralized tech really started properly clashing. So today we're going to try and map that out, synthesize the key moves. Was it just market recovery or something deeper? Regulation, innovation, it all seemed to happen at once. Our goal, to figure out if the institutions are finally stepping in to legitimize things, or maybe, just maybe, DeFi is just getting too big for them to ignore anymore. And the numbers defining this period are pretty wild. First off, Bitcoin. It's surged, holding strong over $115,000. Then there's the DeFi engine room, absolutely roaring. We saw 1.24 trillion with a T in 30-day perpetual trading volume. Staggering. And third, the institutional money keeps flowing. Venture capital funding for the year, it's blown past $19 billion.
Right. And what's really fascinating is how those three things are connected. So, like you said, two parallel tracks running. You've got this incredible tech innovation DeFi, layer 2 scaling up. And then on the other track, you have the institutions and regulators scrambling, trying to either get involved or get control. It's this friction point. To really get a handle on it, you need to understand both sides, the tech and the policy being hammered out right now.
Okay, let's start with the market itself. The Bitcoin bounce, we saw it defend $110,000 like a fortress, really strong support there. And then when it broke decisively above $115,000, that wasn't just a number on a chart, was it? It had real consequences.
Oh, absolutely. That wasn't just a price increase. It was a market structure event. When it pushed through $115K, it triggered immediate liquidations. Millions of dollars in leveraged short positions just wiped out. Textbook short squeeze. It basically tells you the market absorbed all that negative pressure, cleared out the bears, and, well, the path seems clearer for more upward movement. Sentiment definitely shifted bullish.
And that bullishness seems backed by the VC world, too. You mentioned the funding. Our sources confirm $2.5 billion raised by crypto firms just in October alone. Stepping back, that $19 billion year-to-date figure, it's hard to argue the big money isn't still committed, right?
It's a huge number. $19 billion definitely shows commitment. But we should probably look a bit closer at where it's going. Is it just spraying everywhere like last cycle? Or is it more targeted? If you look at the big deals, like that $2 billion investment into a major prediction market platform, that suggests a focus on, let's say, real infrastructure, scalable Web3 stuff that solves actual problems, not just pure speculation.
Interesting. So maybe a sign of maturity? A bit more caution, perhaps?
Could be. It points towards building sustainable businesses on-chain, which, leads us to that interesting nuance we saw in the on-chain data this week.
Right, the profit-taking. Even with the market pumping, there were signs veteran investors were selling.
Exactly. We always keep an eye on the illiquid supply metric. It tracks Bitcoin held by long-term holders, or LTHs, the folks who tend to hold through thick and thin. And the data from Glassnode showed a dip. About 62,000 BPC moved out of those LTH wallets.
Okay, so what does that signal? Is it bearish?
Not necessarily bearish for the whole market, no, but it's classic veteran behavior.
Yeah.
These are investors who've likely held for a long time, seen big gains, and now they're realizing some profits, taking risk off the table. The big question is where that capital is going. Is it just going to cash? Or, and this is critical, are they rotating those profits into newer parts of the ecosystem, maybe things they see as having even higher growth potential now?
That idea of capital rotation is a great transition, because if money is moving, maybe it's looking for stability, clarity, which brings us straight to regulation, and especially stablecoins this week. We have to talk about the Genius Act. The big U.S. federal stablecoin regulation finally landed. For anyone needing a quick reminder, this sets the rules, reserve requirements, audits, who's liable. It's the framework everyone was waiting for.
And the market reaction was instant. Sources showed stablecoin payment volume jumped, get this 70% right after it passed.
70%? That's huge.
It really is. It screams pent-up demand for regulated digital dollars. But, is it just everyday users driving that? Or is it institutions? Think about it. If you're a big player, maybe you were hesitant before. Legal gray areas, reserve questions. Now, with clear rules on reserves and audits, the door is open for them to move serious volume on-chain without that regulatory fear. So clarity equals utility, yes, but it also enables institutional scale.
And speaking of institutions wanting legitimacy, the race for federal charters is definitely on.
Yep, we saw Crypto.com throw their hat in the ring. They formally applied for a national charter from the OCC, the Office of the Controller of the Currency.
Why is that specific charter such a big deal?
Because getting an OCC charter basically transforms you. You stop being just a tech company and become, essentially, a federally regulated financial institution, like a bank under federal supervision. And they're not alone. Coinbase did it. Ripple applied. It shows the major players are actively trying to embed themselves within the traditional financial system, not just operate alongside it. It's a signal to Washington, to Wall Street. We want to play by your rules.
But not all signals from Washington were welcoming, were they? There was definite friction from the Federal Reserve this week.
Yeah, Federal Reserve Governor Waller.
Mm-hmm.
He came out pretty strongly against interest-bearing stablecoins, said they should be a pure payment instrument. Full stop.
Right. And that hits right at the business model for some issuers, doesn't it? If you can't offer yield, which is often how they make money or attract users, how do you compete? It throws a wrench into those ongoing... Senate talks about market structure, too. It forces stablecoin companies to really rethink their revenue streams if they want that federal stamp of approval. A major sticking point. And the regulatory pressure wasn't just at the federal level. New York State took aim at crypto mining.
That's right. New companion bills, A9138 and S8518. The proposal is to slap an excise tax on the electricity used by large-scale proof-of-work miners. Bitcoin miners, basically.
What's the stated goal there? Environment.
Ostensibly, yes. They say it's to encourage greener mining, reduce grid strain. Makes sense on the surface. But the potential downside is obvious, too. If this tax kicks in, scheduled for 2027, I believe, it makes mining in New York significantly more expensive. So what happens? Those operations and the jobs they bring might just pack up and move to states with friendlier policies. It's that classic balancing act, environment versus economy at the state level.
Okay, let's pivot back to the tech side. The decentralized innovation that all this regulation is trying to, well, regulate. If the market's up and the rules are getting clearer, where did the really big trading money flow? The standout metric has to be that DeFi volume. Decentralized perpetual contracts hitting an all-time high. $1.24 trillion in 30-day volume. It's just wow.
It's astronomical. And it shows a fundamental shift, doesn't it? Platforms like Hyperliquid and Aster were leaders in that surge. What it confirms is a real migration of leveraged trading, away from the big centralized exchanges, the CEXs, and onto these decentralized venues, the DEXs.
Why the shift, though? What are DEX offering?
Well, traders seem to be prioritizing things like capital efficiency, maybe faster execution in some cases, and crucially, transparency. They can see the code, they can see the liquidity pools, maybe they trust the smart contract more than a company holding their funds. It suggests that even for high-stakes, fast-paced trading, decentralization is winning converts.
And all this activity, this massive volume, it's starting to translate into valuations that even traditional finance can't ignore anymore. This is where it gets really interesting.
Oh, absolutely. Remember when layer 2s were just theoretical scaling ideas? Now look at this JPMorgan report we saw. They estimated that Coinbase's L2 network base could potentially be valued at up to $34 billion.
$34 billion. For base.
If they launch a token. Right. Exactly. If it launches its own native token. That number is huge. It shows just how much financial value is now seen as being embedded in these successful L2 ecosystems. They're not just tech solutions anymore. They're becoming full-blown financial platforms, generating real fees, real revenue. And the token. That's the mechanism to capture and distribute that value. It basically allows these L2s to have financial structures that could rival established financial firms. It's a game changer.
And it's not just complex finance stuff. We're seeing Bitcoin adoption push into new areas like the creator economy.
Yeah, that Rumble announcement was interesting. The video platform backed by Tether. Notably, they plan to roll out Bitcoin tipping in December.
For how many users?
Get this, 51 million monthly users. That's plugging Bitcoin directly into a pretty mainstream platform.
So it moves Bitcoin beyond just being digital gold or something to trade.
Precisely. It positions it as a practical payment tool, a medium exchange for creators and their audiences, just straightforward utility.
Okay, let's pull this all together. What are the key takeaways for you listening right now? Looking back at that week in late October 2025, it really feels like an acceleration point. We saw the institutional commitment solidify that $19 billion in VC money, the exchanges rushing for OCC charters.
Right. And at the exact same time, decentralized activity just went ballistic. That trillion-dollar DeFi volume is the headline there. The connection seems to be regulation acting as an accelerator, actually. Look at the 70% stablecoin surge right after the Genius Act. Clear rules brought money off the sidelines. Even with the friction points, Governor Waller saying no to yield, the New York mining tax proposal, the overall trend is towards utility being unlocked by clarity. So the focus is shifting. It's not just about holding Bitcoin or Ether anymore. It's about building and using these on-chain ecosystems that generate real value, real revenue. That feels like the big structural shift.
Which brings us to that final thought for you to chew on. We talked about those 62,000 BTC moving from long-term holders. It's smart, patient capital taking profits. Now, connect that to the potential $34 billion valuation for something like the base layer 2. If that veteran money is rotating out of Bitcoin, where do you think it might be going? Are we actually seeing the early stages of the L2 layer becoming truly financialized? Is that where the next wave of growth and value capture is heading? Something to think about.